Euro, monetary unit and currency of the European Union, EU. It was introduced as a non-cash monetary unit in 1999, and currency notes and coins appeared in participating countries on January 1, 2002. After February 28, 2002, the euro became the sole currency of 12 EU member states, and their national currencies ceased to be legal tender. Other states subsequently adopted the currency. The euro is represented by the symbol euro. The euro is the currency and monetary unit of the European Union, symbolized by the euro sign. The euro was first launched as a non-cash monetary unit in 1999, and currency coins and notes were released in 2002. The euro replaced the currencies of EU members as well as certain non-EU countries. The Maastricht Treaty, 1991, which included the creation of an economic and monetary union, EMU, was signed by the then 12 member countries of the European Community, now the European Union, the United Kingdom, Germany, Italy, France, Ireland, Belgium, Denmark, Spain, Portugal, Greece, Netherlands, and Luxembourg. The treaty proposed a single currency, the euro, and established tight requirements for euro conversion and membership in the EMU. Annual budget deficits of no more than 3% of GDP, exchange rate stability, the public debt of no more than 60% of GDP, inflation rates within 1.5% of the EU's three lowest inflation rates, and long-term inflation rates of no more than 2% were among the conditions. Even though several states held public debt ratios surpassing 60%, especially Italy and Belgium, where the rates reached 120%, the European Commission endorsed their admission to the EMU, highlighting the crucial steps each nation had taken to minimize its debt ratio. Euro enthusiasts reasoned that a common European currency would stimulate trade by eliminating the volatility of foreign exchange and decreasing prices. Despite fears about losing national sovereignty, identity, and counterfeiting, 11 nations joined the EMU officially in 1998. Although some firms in the United Kingdom had agreed to accept payment in euros, the United Kingdom and Sweden had delayed enrolling. In a referendum in September 2000, Danes barely managed to reject the euro. Initially, Greece failed to reach the financial requirements. After reforming its economy, Greece made the final cut in January 2001. Despite all EU nations being members of the Economic and Monetary Union, EMU, only 19 have exchanged their national currencies with the euro. These countries which use the euro form a region known as the Eurozone. Eurozone includes Germany, Austria, France, Belgium, Cyprus, Estonia, Finland, Italy, Portugal, Greece, Ireland, Latvia, Spain, Lithuania, Luxembourg, Malta, Slovakia, Slovenia, the Netherlands. Non-euro area member countries have not yet adopted the euro but will do so once the essential circumstances are met. It mainly consists of nations that joined the Union after the euro was introduced in 2002, i.e. 2004, 2007, and 2013. They are Bulgaria, Croatia, Czechia, Hungary, Poland, Romania, Sweden. The European Central Bank, ECB, was founded in 1998 to oversee the new currency. The European Central Bank, ECB, is based in Frankfurt, Germany, led by a nominated president elected by all the member countries for an 8-year period. On January 1, 1999, the euro was introduced as a 1:1 replacement for the predecessor European currency unit. Financial markets and a few businesses solely utilized the euro before launching currency coins and notes in 2002. Many experts believed that the euro would eventually be able to compete with the US dollar as a global currency. Unlike the previous national currencies, euro banknotes never featured any prominent national figure. Instead, the 7 colorful notes, designed by an Austrian artist Robert Kalina, ranging in denominations of value €5 to €500, depict a map of Europe, the EU flag, bridges, arches, gateways, windows, etc. symbolize Europe's unity. The denominations of the 8 euro coins range from 1 cent to 2 euros. The coins have a standard design on one side and different designs on the reverse sides in each participating country. The euro is the exclusive legal tender in all the EU member countries that have adopted it. These countries make up the Eurozone, an area whose shared currency is the euro. The euro is also used as the official currency of 4 tiny non-EU countries, Andorra, Vatican City, San Marino, and Monaco, and numerous countries' currencies are tied to the euro. The European Union mandates the European Central Bank, ECB, to preserve price stability by protecting the euro's value. The ECB and national central banks of all EU member states, even those that have not accepted the euro, make up the European System of Central Banks, ESCB. In the increasingly interconnected EU economy, accepting the euro reduced foreign exchange risk for European businesses and financial organizations with cross-border activities. The monetary and fiscal constraints for adopting the euro also have fostered increased political integration among member countries. The Eurozone, on the contrary, brings together economies with diverse national budgets and disparate characteristics without the power to undertake the sorts of cross-border fiscal transfers which occur in the United States between both the federal government and states. As a result of the market instability created by the European sovereign debt crisis, the EU has been compelled to implement measures such as ECB guarantees for debt issued by member states. Because of their dependency on the ECB's fiscal policy and EU budget restrictions, governments and central banks are limited in their ability to respond to economical situations in their own countries. For example, a country's central bank can no longer reduce interest rates by weakening its native currency versus its significant European trade relations to boost exports. While the euro cannot be discounted to ease EU economic reforms, it has become a more reliable store of value. The euro continues to enjoy widespread acceptance among citizens of the nations that have accepted it. Although there were concerns regarding a single currency, including worries about counterfeiting and loss of national sovereignty and national identity, 11 countries, Austria, Belgium, Finland, France, Germany, Ireland, Italy, Luxembourg, the Netherlands, Portugal, and Spain, formally joined the EMU in 1998. Britain and Sweden delayed joining, though some businesses in Britain decided to accept payment in euros. Voters in Denmark narrowly rejected the euro in a September 2000 referendum. Greece initially failed to meet the economic requirements but was admitted in January 2001 after overhauling its economy. In 2007 Slovenia became the first former communist country to adopt the euro. Having demonstrated fiscal stability since joining the EU in 2004, both Malta and the Greek Cypriot sector of Cyprus adopted the euro in 2008. Other countries that adopted the currency include Slovakia, 2009, Estonia, 2011, Latvia, 2014, Lithuania, 2015, and Croatia, 2023. The euro is also the official currency in several areas outside the EU, including Andorra, Montenegro, Kosovo, and San Marino. The 20 participating EU countries are known as the Euro area, Euroland, or the Eurozone. In 1998 the European Central Bank, ECB, was established to manage the new currency. Based in Frankfurt, Germany, the ECB is an independent and neutral body headed by an appointed president who is approved by all member countries to serve an 8-year term. The euro was launched on January 1, 1999, replacing the precursor ECU at a 1:1 value. Until the circulation of currency notes and coins in 2002, the euro was used only by financial markets and certain businesses. Many experts predicted that the euro could eventually rival the US dollar as an international currency. Unlike most of the national currencies that they replaced, euro banknotes do not display famous national figures. The 7 colorful bills, designed by the Austrian artist Robert Kalina and ranging in denomination from €5 to €500, symbolize the unity of Europe and feature a map of Europe, the EU's flag, and arches, bridges, gateways, and windows. The 8 euro coins range in denominations from 1 cent to €2. The coins feature one side with a common design, the reverse side's designs differ in each of the individual participating countries. The main benefits of the euro are related to increased trade. Travel was made easier by removing the need for exchanging money. More importantly, the currency risks were eliminated from European trade. With the euro, European businesses can easily lock in the best prices from suppliers in other Eurozone countries. That makes prices transparent and increases the competition between firms in countries using the euro. Labor and goods can flow more easily across borders to where they are needed, making the whole union work more efficiently. The euro also supports cross-border investments within the Eurozone. Investors in countries using foreign currencies face significant foreign exchange risk, which can lead to an inefficient allocation of capital. Although stocks also have exchange rate risks, the impact on bonds is far greater because of their lower volatility. The prices of most debt instruments are so stable that exchange rates influence returns far more than interest rates or credit quality. As a result, foreign currency bonds have a poor risk-return profile for most investors. Before the euro, successful companies in countries with weak currencies still had to pay high interest rates. On the other hand, less efficient firms in nations with stable currencies enjoyed relatively low interest rates. The primary risk in lending across borders was the currency risk, instead of default risk. With the euro, investors in low interest rate countries, such as Germany and the Netherlands, were able to lend money to firms in other Eurozone countries without currency risk. By far, the largest drawback of the euro is a single monetary policy that often does not fit local economic conditions. It is common for parts of the EU to be prospering, with high growth and low unemployment. In contrast, others suffer from prolonged economic downturns and high unemployment. The classic Keynesian solutions for these problems are entirely different. The high-growth country ought to have high interest rates to prevent inflation, overheating, and an eventual economic crash. The low-growth country should lower interest rates to stimulate borrowing. In theory, countries with high unemployment do not need to worry much about inflation because of the availability of the unemployed to produce more goods. Unfortunately, interest rates cannot be simultaneously raised in the high-growth country and lowered in the low-growth country when they have a single currency like the euro. In fact, the euro caused precisely the opposite of standard economic policy to be implemented during the European sovereign debt crisis. As growth slowed and unemployment increased in countries like Italy and Greece, investors feared for their solvency, driving up interest rates. Typically, there would be no solvency fears for governments under a fiat money regime because the national government could order the central bank to print more money. However, the European Central Bank's independence meant printing money was not an option for Eurozone governments. Higher interest rates increased unemployment and even caused deflation and negative economic growth in some countries. It would be fair to say that the euro contributed to an economic depression in Greece. The first stage of the euro was the European Exchange Rate Mechanism, ERM, under which prospective future members of the Eurozone fixed their exchange rates to the German mark. Germany has the largest economy in the Eurozone and had a history of sound monetary policy since World War II. However, pegging exchange rates to the German mark may have created a bias in favor of Germany. The idea that the euro favors Germany is politically controversial, but there is some support for it. In the 1990s, Germany pursued a looser monetary policy to deal with the burdens of reunification. As a result, the strong UK economy of that era experienced excessive inflation. The UK was first forced to raise interest rates and eventually pushed out of the ERM on Black Wednesday in 1992. The German economy was relatively prosperous by 2012, and European monetary policy was far too tight for weaker economies. Portugal, Italy, Ireland, Greece, and Spain all faced high debt, high interest rates, and high unemployment. This time, monetary policy was too tight rather than too loose. The only constant was that the euro continued to work in favor of Germany. The euro is fundamentally a tool to enhance political solidarity. This political motivation began when the idea of the European Union and a single currency was first conceived. While it also has the economic effect of unifying the economies of participating countries, it ultimately does much more for the European Union. Economically, the euro's advantages include elimination of exchange rate fluctuations. Any time either a consumer or a business made a commitment to buy something in a different country in the future, at future prices, they stood the chance of paying much more, or less, than they had planned. The euro eliminates the fluctuations of currency values across certain borders. Price transparency, being able to easily tell if a price in one country is better than the price in another is also a big benefit, both for consumers and businesses. With price equalization across borders, businesses have to be more competitive. Pricing still varies, but consumers can more easily spot a good deal or a bad one. Transaction costs, this is particularly helpful for tourists and others who cross several borders during the course of a trip. Before, they had to exchange their money as they entered each new country. The costs of all of these exchanges added up significantly. With the euro, no exchanges are necessary within the Euroland countries. Increased trade across borders, the price transparency, elimination of exchange rate fluctuations, and the elimination of exchange transaction costs all contribute to an increase in trade across borders of all the Euroland countries. Increased cross-border employment, not only can business be conducted across borders more easily, but people are more easily employable across borders. With a single currency, it is less cumbersome for people to cross into the next country to work, because their salary is paid in the same currency they use in their own country. Simplified billing, billing for services, products, or other types of payments are simplified with the euro. Expanding markets for business, business can expand more easily into neighboring countries. Rather than having to set up separate accounting systems, banks, etc. for transactions in countries other than their native one, the euro makes it simple to operate from a single central accounting office and use a single bank. Financial market stability, on a larger scale, the financial and stock exchanges can list every financial instrument in euros rather than in each nation's denomination. This has further ramifications in that it promotes trade with less restriction internationally, as well as strengthens the European financial markets. Banks can offer financial products, loans, CDs, etc., to countries throughout Euroland. Macroeconomic stability, because of the European Central Bank, ECB, introduction of the euro also helps to lower, and control, inflation among the EU countries. Lower interest rate, because of the decreased exchange rate risk, the euro encourages lower interest rates. In the past, additional interest was charged to cover the risk of the exchange rate fluctuation. This risk is gone with the introduction of the euro. Structural reform for European economies, the participation requirements of the euro pushed many EU member states who wanted to participate to get their economies in shape and improve their economic growth. With the requirements of the Stability and Growth Pact, they will also have to maintain that control in the future, or face fines. Thank you for watching this video.